Okay, first of all, first thing we see is we have a lot of earnings reports this week. First of all, this is the last week the banks started earnings season, and with J.P. Morgan, and we had a couple other banks, Bank of America. This week we're starting to get a lot of the S&P 500 earnings to report. Today we had some. That's what's happening here. Okay. Okay, so we've had a rally in the stock market recently. We're up 1% since last week. We have the Dow up for the last 10 days in a row. We have a lot of momentum. Let's look at. Okay, so let's look at our stocks trading above 200-day moving average. We have 86% this week versus 85 last week, and the amount over the amount over the 200-day moving average is 72% this week versus 69 last week. So that means that there is momentum building, and the market breadth is increasing. So that's all positive for the stock market to continue to go up. So we have the 10-year and the 2-year are up 2%. We're not paying as much attention to that anymore because it's not as interesting as it was in the past. Because the Fed's almost done raising rates. We're going to see in the meeting notes that next week, we're right here, next week on Wednesday, the Fed's going to have a meeting. So a lot of times the stock market doesn't do anything until that happens. So let's see what happens then. There might be a raise of rates after, but we know August and September are traditionally bad months for the stock market. They're usually negative. And I have a couple of charts this week for that. One is we see the average since 1980 is down. And we see this is a seasonality index. We can see in July it's usually going up primarily because earnings come out in July, and that's a good catalyst for stocks to go up. But there is no news going out in August, and September. Earnings are pretty much over, and it won't be until October we get another set of earnings. All right, so we're going into a slower time of the calendar, August and September, so we're not expecting much. But July is traditionally a good month in the stock market, so we're expecting at least a good finish to the month. Okay, can you still hear me?
Yeah.
Yeah.
Okay, that's good. You never know until you ask. All right, so let me see. Let's go to some of our talking points. Okay, one of the most important things that we have to keep in the back of our mind is the liquidity in comparison to the S&P 500. And as liquidity goes up, the multiples that people are willing to pay for the S&P 500 go up. But as liquidity goes down, the S&P 500 multiples go down that people are willing to pay. So in other words, right now there's a 19 PE in the S&P 500. And, when there's zero interest rates, people are willing to pay 21 or 25 PE for the S&P 500 earnings. But now that the liquidity is being drained, the investing public aren't as willing to pay premiums. So that's very important right now. The liquidity is going down. And so that means most likely that the S&P 500 PE ratio will go down also. That means the stock market should correct at some point in time in the future here. And that pretty much matches our next 2 months of red in the calendar. All right, so let's look at the S&P 500. We're super overbought. So if you look at Okay, I'm zooming in on this. You can see that the stochastics were at 93. We've been overbought for a while. We're at the top of the range of our channel, and we're approaching a month that's traditionally bad in the stock market. So we have a lot of indicators that we're going to be going back down to this part. There's a couple of different reasons. One is right now the S&P is very over the moving averages. A lot of times the S&P 500 goes back down to touch the moving averages as it goes up in an uptrend. So there's a lot of reasons. That's one of the biggest reasons. A lot of times the indexes move towards the moving averages. And you can see these values here, these right here are moving averages. The purple, yellow line, green line, and the red line. So don't be surprised if we check back and go down a little bit lower in the future. To me, you just have to keep track of those things so you're not surprised whenever the stock market goes down. Okay, so we have a lot of indications from smart people. This guy's a hedge fund manager, Doug Cass, and he says that he's bearish for the remainder of the year. He says the downside risks dwarf the upside reward. And he doesn't see many opportunities now for establishing new positions. So he says basically that the stock market isn't growing a whole lot, and we're going to be treading water for a while. For me, looking at this, I'm a long-term investor, so I guess I can see we might be holding some of our stocks that might not be going up for a year or so. But I'm not going to be selling based on that, though. Let's look at another thing from Twitter. There's Gene Munster. He's an analyst for the tech world. And he says, Musk says on a call that he's in discussion with major OEMs to license full self-driving technologies. So, every week I'm coming up with new reasons and catalysts for Tesla that weren't there before. And this is another way to license technology to make money. Okay, I included this in our notes here for the meeting, but there's another person who's very famous for his understanding of startups and investing in general. And he was behind Amazon and Tesla 10 years ago. And he had this thesis, and it came true. And he has a new thesis for Tesla being like a super growth stock. And he's saying the things that are happening, like we noticed last week and the week before, things that are happening recently with Tesla, they're positioning themselves very similar to Apple, how Apple positioned themselves in the year 2012, 10 years ago. So he thinks that Tesla's iPhone moment is now at hand. So he says, right now, he says basically high interest rates are holding back sales of cars. So whenever the interest rates go down again, they're going to sell a lot more. The first thing. And right now, Tesla is basically selling more cars at discounts, and they're taking a hit on margins, so they're selling them maybe at cost or a little bit above cost to get market share. And then they're going to raise their prices later on when they have a good portion of the market. That's what Apple did in 2012. And we noticed this talking point last week. They struck deals to license their FSD, but they're full self-driving, and they could be that could be similar to the App Store for Apple. And he said, this is the last one here, when Apple ran the same playbook towards global domination, they took the GMs down, the gross margins down 15 to 20% while they're establishing their market share, and then they rose them up. 10 years later. So he thinks that right now I checked the earnings estimates for Tesla. It's not changing yet. So let's keep all these things in mind. This could be an iPhone moment for Tesla, and there's a lot of things that could be happening we don't know about, and they're not in the numbers. So let's keep track of that as a potential long-term growth stock. Any questions on that?
Yeah. So Tia is he's a VC. He did a lot of SPACs during like the SPAC boom. He has a weekly podcast. I've listened to quite a bit of his stuff. So he's friends with Elon. So yeah, it'll be interesting to see what happens. Yeah.
So yeah, for someone who's a VC that actually is an investor that does a lot of stocks or whatever, and he sees there's potential in Tesla that other don't have in their estimates. I don't know. It's something to keep in mind because a lot of times you can't rely on the estimates, and you have to do some on the napkin calculations to figure out if this is going to work as a growth stock. And it seems like some of the things that they're doing are they're cornering the market in a lot of things. So let's see if they actually corner the market in charging network. Maybe they have the largest market share in EV production and battery. The battery production. We'll keep our eyes on that, but right now their estimates aren't changing, so it's not really obvious to me yet if it's a good deal or not. So we just have to wait for that investing thesis to work its way to the numbers in the end. Okay, now let's look at some more things. Okay, Pepsi actually had earnings last week, and they're raising their estimate. One thing they talked about during the call was the Frito-Lay is the fastest growing segment. So they basically own the largest snack manufacturer in the country right now, and their margins on making snacks are much greater than making Pepsi and drinks. So what I did was I just did, every time there's a news story on a stock, I like to go back and check to make sure our theses are correct and everything is still, the company's still growing. And so what I did was I looked at their earnings estimate, and it seems like they're growing around between 8 and 10%. Let's say 8%. But they have a dividend of 2.67%. So their total return is 10.67%. And they're growing, the P/E ratio is pretty high. It's 30, it's 25. So that means the PEG ratio is 3. And that's pretty high. But it's been very consistent in growing at 8% and with a dividend. So those that are interested in dividends, this is like a stock that would grow and give a dividend. And it's pretty consistent. And they've raised their prices this past year, and maybe they'll keep them high because there hasn't been a demand problem. All right. So their statistics, we're looking at their profit margin isn't that great. It's 8, but the return on equity is really good, 43. And they don't have a whole lot of debt either, so that all matches up. And their chart, even it's basically towards the bottom of their channel. And if you're interested in a total return, time to buy this would be when the stock market's selling off, not at the all-time high like right now. I mean, the S&P is like near an all-time high. So you have to wait for the next month or two whenever everything is selling off, and then just go back down to the bottom of this channel. All right. So this is getting less interesting every week because a lot of this is settling down. We have the oil that's not changing at all. We have inflation, it's lowering. it was 4% earlier this year. Now it's 3%. And the dollar is up a little bit, but it's been going down. And gold isn't going anywhere either. Okay, so here agreed, we're still at 80. This matches our momentum that we've seen in the stock market. People are greedy, and it's a very powerful thing, momentum. And it's hard to be short in this kind of environment when you have everything going up. But eventually, like Doug Cass says, the trees don't grow to the sky, so you have to eventually get a pullback. So that's what's probably happening pretty soon. Dollar index continues to go down. That gives 2 to 5% on the earnings for multinationals. So that's still matching up really good with owning large cap stocks right now. And that's really good for commodities like gold or anything priced in U.S. dollars. So the more it goes down, the dollar, the higher the prices for commodities go up. Right. So VIX is still really low. It's still at 13. That corresponds with the stock market going up. There's like a bull market. No one's afraid right now. All right. So, and we're basically at the top of this in the emotional chart. Everyone's still excited, and we just need one big news story to start correcting again. That'll probably happen the next week or two. All right. Next thing is I saw this article on the front page of Yahoo Finance. Is it today? Okay. It was today. It said American Express beats profit estimates as card spending rises. And from that article, we have an understanding that the economy is good, number one. Number two, consumers are still spending. Number three, that's probably good for every credit card maker. So our thesis for Visa and MasterCard, they'll probably go up with this news story. And it's at this kind of time, we have MasterCard and Visa that we're following. And it goes to assume that if those have all the numbers we're looking for, stocks like Amex or Discover Card have similar business models where they have the similar numbers. So what I did was I said, let's go through this to see if it matches some of our criteria, and let's go through some of the thesis why it would be good or a bad investment. Okay. First of all, I looked at their projections for earnings. They're actually down today. Let's look at what they're at right now. Okay, so they're down a little bit today, 3%. Okay, so they're growing around 12%. Let's say 12%, and their PE ratio is only 16. So that means they're pretty fairly valued at 1, PEG ratio 1.3. And that's like the PEG ratio for the other credit cards. Visa and MasterCard are a lot more than that. They're like 2 or 3. So there has to be something. This is maybe 5% of global share of the market, where Visa is like 70 or 60%. So the investing themes, people are spending more on travel now. There's a pent-up demand. They have a higher end client. So they have richer clients that won't default on their credit card payments. And people around the world are switching from cash to credit. So most transactions in the world are cash. The best thing about this is Berkshire Hathaway has had a position in this for 20 or 30 years or more. So they believe in it, and it must, if they're still holding it, it still must be a good company. So they have a dividend of 1%, so the total return is around 13. So, so this is a lot cheaper than Visa and MasterCard, but is it worth it? We're going to look. So it has 4P is 16 and PEG ratio is 1.26. So these numbers are good here. The profit margin and the return on equity are good. Let's look at Morningstar and CFRA set of odds. Morningstar says they're about fairly valued. Their fair value is where it's trading at. And so they said that the surge in travel spending, net interest income drives revenue growth. Okay, so let me see what else it's saying. Okay, so MasterCard and Visa are also benefiting from travel because people spend more whenever they're on vacation. Yeah, let me see. Okay, so what's different between MasterCard, Visa, and American Express is most of American Express customers pay an annual fee, I think. So that's what they say here. The card fees are impressive, and they have a richer clientele, and they have spend-centric business model. So if you get like dividend back, if you spend a lot. Okay, and they have loan loss provisions. So I guess when you lend money to customers, a certain portion of them are going to default, and so the company has to keep money around for that. And anyway, this is very inexpensive compared to Visa and MasterCard. So let's look at the last thing here. It's very important. CFRA said that they're undervalued by 10%. And right here, you can see that their dividends are increasing steadily over time, which is good if you're a dividend investor, because as inflation goes up, your dividend payment goes up with it, so you don't lose as much in buying power. And the earnings are actually going up too over time. You can see the earnings. So that's very positive. And what also we have a P of 16. That's right in the middle of what that's a fair. That's right in the middle of the high and the low for the past 10 years. So this is like a fairly valued stock, and I guess our exercise here just to understand it's a fair value now. In a month or two, when everything is selling off, it'll get more reasonable and it'll be on sale. So this is a very consistent company that has consistent earnings profile that we can buy whenever it's on sale. We'll revisit it whenever there's a stock market sell-off and see how much it's on sale. Okay, I just drew the chart of this. You can see we're kind of overbought right in the middle of the channel, the top and the bottom. So it's not really a good time to buy. But we would buy when it's down here, or when the whole stock market is selling off. Let's look at the what happened during the pandemic. Went down to 71 during the pandemic. 74, 71. So it went all the way down to 71 because people weren't spending as much when everything was shut down. So we do these exercises like this because eventually there's going to be a sell-off and we're going to be ready. If it sells off this year, it'll probably get down to 137 or 153, which are prior levels of support. So we're gonna go back to the stock whenever it sells off to that time and to that level, and the numbers are still okay. All right. Okay, now we're going to go over some of the sectors that are going up and down today. One's going down the most are regional banking, banks, and retail, financial companies. Okay, those are doing the worst. The ones doing the best: utilities, healthcare, biotech. Okay, so I think every day this year, recently anyway, we've been having a fight between the stocks that did good last year and the stocks that did bad last year, and they're kind of this year. Today we're doing where the things that are going up the most are the ones that went up the most last year, and the ones that are going down the most this year are the ones. Well, I can't make that generalization. Banks going down. But we have that same bifurcated market. And let's look at, but it's the stocks are moving away from interest rate sensitivity because there's not a whole lot of uncertainty around that now. Let's look at okay. Let's look at individual stocks that are going up and down today. We have okay, we have some regional banks going down. Okay, regional banks. We were saying a couple of weeks ago, we were guessing at what could cause the next leg down in the stock market. So if we're looking at, let's look at okay, look at August and September. We have a theory that these are going to be bad months because they're bad months most of the time. So let's guess at what could cause that. The first thing we said 2 weeks ago was a banking crisis, some kind of commercial real estate defaults or something like that. And so as we come towards the end of July, we're going to be anticipating something like that happening. Because the banks are starting to feel that potential of defaults. Let's look at Matthew. You're pretty good at this. What other reasons? You said commercial real estate last time. What other things could happen that could cause people to be nervous again?
Well, I'm still on the commercial real estate train. So yeah, actually the like job reports have been surprisingly good. I think the higher interest rates continue to be an issue. I think a lot of people have. I think there's evidence that a lot of people had gained a lot of savings through COVID and the government stimulus checks. I think a lot of that savings is gone. So I think consumers are being squeezed. I think people are there's debt increases. They're putting things on credit cards. So they burn through their savings and now they're keeping their spending up. And with inflation, a lot of that's kind of necessary spending. Food prices and stuff have gone up quite a bit. So I think that the American consumer, I think, is going to have to pull back.
Okay, now let's think about based on your American consumer pulling back, their heavy debt load, what companies will do good and what companies will do bad in that scenario, and based on that, we would look at some of the things that are going up and down today and see why that's happening. For instance, I would think the toll collectors, like the Visa, MasterCard, they do not have anything to do with defaults. Mm-hmm. The only things that they deal with are guarantees. If the transaction went through, they guarantee, certain kind of part of that transaction. But, the banks are the ones that actually take a hit whenever someone doesn't pay their credit card payment and they default or go bankrupt. So perhaps that's why the banks are going down today, because there's not only an anticipation of the commercial real estate for regional banks, you also have people, they make the banks are increasing their interest rate to 20%, and at times, so that's an all-time high for people. At the same time, there's going to be defaults. So banks are going to have to provision more money for defaults. That means they can't use that money to grow. And on top of that, they'll lose money on their earnings reports for losses, people declaring bankruptcy. So that's a good reason why the banks are going down today, and maybe the Visa and MasterCards are going up because there's more reliability with, transactions. People are still spending money, but they're not taking as much, it's a little more reliable. But I think Discover Card and Amex, they are not bank-oriented, and they are taking risks with lending money to people to spend every month. So that could be why Discover Card is down today. Let's look at Discover Card. I think I saw that here, Discover Card. Okay, so we have these are advertising companies, Omnicom. Zion is the bank, CSX, Railroad, American Express is down. Okay, so that could be why we have a lot of these decliners today. Let's look at the ones that are going up the most. Discover Card. Let's look at Discover Card, because we looked at American Express, but we didn't really. Discover Card is the fourth major credit card in America. So let's look at that. DFS. Okay. And they handle, so basically they lend money to people every month, and they take the risk of defaults. And let's look at the statistics for Discover Card. Discover Financial. Oh man, they have a very low PE. It's 7. The PEG ratio is unavailable. We'll have to calculate that. The profit margin is 0. Okay, Warren Buffett would not be interested in this. All these the numbers aren't even existent, so we can't even figure out something for this. So we have to ignore this one for now. All right, so that was a good lesson learned. Let's look at some more market movers for NASDAQ. Okay, Qualcomm. Okay, that could be considered an AI stock in a way. You see. Okay, a lot of antivirus companies are up today. We have CrowdStrike. We have these are all high PE stocks that have been high price to earnings ratios. CrowdStrike, Airbnb. Qualcomm has a really low PE. One's going down the most. Sirius Radio, Meta. Okay, we just have some profit taking for the stocks that went up the most this year. All right, so let me see what other things going on in the Dow. Okay, so today we have the stocks that are highest quality, largest dividend, the more stable and consistent and low growth stocks. Those are going up the most. And the ones going down the most are the ones that have ran up year to date, seemingly. Except for American Express, and they have earnings up today. Okay, so let's look at some more things that we can go over. Hold on. Okay, let's look at what's going on in the next month or two. Okay, so we have the Fed may be raising rates next week. So there's a lot of uncertainty around that. The Fed will have another meeting September 4th. And then we have end of quarter window dressing in September. So we have 2 bad months, and then a good time is towards the end of that month. October is pretty much either it's statistically a good month, it's usually up, but people associate October with crashes, so that might happen then. And then at the end of the year, we have December, which is always Christmas before Happy, and then we have a good end of year rally. And then the first year, January is usually a good pensions are allocating new resources, and there's usually a kick in the first couple weeks of January. We were saying this last year that home demand could return because there's interest rates that start going down probably at the end of this year or beginning of next year. Okay, that's our calendar of events. What else are we going to look at here? Hold on. So we're getting there. Okay. All right. So now let's go over the stochastics, because we do this every now and then, probably once a month. And it's really good to go over the indexes and the stocks, just so you can understand where you're going to buy things if you're interested in buying them. Okay. So right now, almost every index we follow is high. But you see this space right here, when it's above 80, that's overbought. And when it's at the top of its range, it's not a time to buy. You want to buy it when it's under 20, and when it's towards the bottom of its range. QQQ is overbought. It's super overbought. You can see how far it is away from its moving averages, and usually indexes gravitate towards its 50-day first, and then 100-day, 200-day. So it's way out of line right now. So it's pretty dangerous right now to start buying things. The defense sector ETF, DEFN, it's basically sideways, and there's nothing exciting until there's a war, I think. Gold is in an uptrend, but it's overbought. You can see that. Consumer discretionary, it's overbought with the market. It's at 87. So this is not a good time to be looking into buying that. Materials, this is in an uptrend. This is kind of the inverse correlation of the U.S. dollar. So if we map the XLD material sector to the U.S. dollar, probably 1-to-1 inverse correlation. Let's do that real quick. XLD. Let's look at it. So we'll do a comparison. I think no, that's not it. Actually, I can't do a comparison because I don't think the okay, I can't do it. That was a good idea, but does anyone know a symbol for a dollar compared to other currencies? I thought it was DXY, but it isn't.
I'm not sure.
Let's see if we can. Euro, US dollar, US. Okay, you can see, let me see, is there an inverse correlation? I think there is. Look at that. This is the US dollar, and every time this goes down, the US dollar goes up. So it's like the opposite. Okay, that makes sense. So basically, as materials are priced in U.S. dollars, as the U.S. dollar goes down, the price of the materials go up. So that's a good thing to keep in mind. So that's good exercise. Okay. Communication sector. All right, that's going up. We're overbought in communication services. Healthcare. 73. That's overbought, but still, it seems like when everything else is going to be going down in the next 2 months, this is going to be a stable sector to invest in because it's basically paid a dividend and it's pretty conservative in a steady demand for the products. So there are a lot of people that are selling out of tech right now and getting more into dividend-paying healthcare stocks. Look at industrial. They're basically at the top of the range and overbought. So that's following the S&P. Let's see. Consumer staples. Almost every dividend stock we're following matches this. It's basically in the sideways this year. And financial sector is sideways too. And it's overbought. Actually, super overbought. So let me see. XLU, this is an example of like a dividend stock. It's in the sideways pattern. And there's room in the next month for this to go up to the top of this channel here. And it's halfway between overbought and oversold. And retail sector is in the downtrend. It's one of the only ones in the downtrend now. XLE, the energy, is in a sideways pattern. They pay a dividend, and I think the whole world economy is halfway between good and bad. Like, so I think if the economies around the world were doing really good, this would be going up. But right now, almost every economy in the world is bordering on a recession or no growth. That's why it's kind of sideways right now. And we've been following this EWZ for a while now. It's paying an 11% dividend, 12% dividend now. And it's trading between this range right here and right here. So it's kind of overbought right now, but when it gets down to here, it'll pay 15% dividend, and that'll be interesting. But it's totally uncorrelated to American stocks. So that could be a good way to diversify. I bought a little bit of this, and I'm going to follow it until it goes down to here and maybe get some more. Uranium. That doesn't go in anywhere. It's like a dividend stock. Okay, let's look at the stocks we're following. The drug stocks did really bad this year so far. They're either negative or zero returns. And all of a sudden, people are starting to buy these as an alternative to all the stocks that have gone up so far this year. So they're starting to have a new interest in the stock market. For me, I've held this since the pandemic, so it pays dividend and it has a small amount of growth. I'm basically holding it for a dividend. Abbott Laboratories, they had good earnings, and so they're halfway between their top and the bottom channel, and they're oversold right now. So a lot of these stocks that were drug stocks were going up, are starting to go up now. They were ignored so far this year. Alibaba, it's kind of in a sideways pattern. It's not really going anywhere. Alphabet is at the bottom end of its range of, it's been going up pretty consistently on AI hype, and it's a little bit overbought. So right now it's probably going to go back down to this part of the channel. Altria, this is one of the most reliable dividend stocks and one of my biggest dividend positions. It's yielding 8%, and it's halfway between overbought and oversold. So to wait till it gets done here to buy some. And Amazon, it's been in an uptrend. It's one of the most expensive stocks that we're following. It has a PEG ratio of like 5 or 7. And its PE ratio is 70, so it's super dangerous right now. Any comments on that? No comments. Okay. So you can see it's a 70, and a lot of stocks that have rallied, like Facebook, Amazon, Microsoft, Apple, people are just starting to take off like 10%, traders, because they've all ran up so much, and they're putting it into healthcare and more conservative stocks right now. So this is like a turning point in the stock market now. We had this huge run in the stock market, and let's look at the S&P right now. Okay, we've had a huge run. We're up to this prior resistance right here, and this is all-time high territory right here. So a lot of times whenever you work your way back to an all-time high, you go back like this, you go back a little bit like that. So we might be consolidating, and right now people are taking profits in the stocks that went up the most this year. And so you have to be ready for this little pullback. It's not a big deal. But right now, Apple and Amazon and Microsoft, they are just defying gravity. They keep going up, and it won't go up forever. Right now, Apple is at a new all-time high, and overbought. So they're super, super expensive. It's really hard to get. It's not a good idea to buy it right now. All right, and okay, here's a stock we've been following for a while, this AT&T. They had a news story came out right after our last meeting that they might have liability for lead cable in the field, and that went down like 10% that day. And in reality, that might not have been a bad problem after all, because they said only 10% of their cables have that lead, and so it might not be a huge liability for them after all. But we've been saying that they're losing market share. There's all kind of bad news around the stocks already. If there was a liability, that could be like a last straw. I don't know. But they are at a level of support right here. In October of last year, they were at that same level. So there is support there. But they're risking losing a portion of their dividend. So we're going to keep our eyes on that as they exercise to see if they reduce their dividend at all. Bristol Myers, we're going to look at this stock. I actually sold this like last year because I saw the estimates going down for the company, so I haven't checked on it for a while. I'm going to check on there to see if they're actually growing again. Hold on. That's it now. Okay, so we're going to look at the earnings estimate. The last time I looked, they basically thought they were growing like consistently 10% a year, and then it started turning to they were earning only 2% for the next. Let's see where they're at right now. Yeah, this is still not very good. Look at that. Let's look at do the calculations real quick. So what we're doing, we're basically going through these numbers, dividing the years. So 8 divided by 8.12, it's growing 1.5% between this year and next. 8.12 divided by 8.30, 2.1% next year. 2.24. Now it's growing negative after that. So you can see, although it's consistently 8, they'll pay their dividends, but they're not growing at all anymore, maybe 1% a year. So that's why whenever you see something like that happen, you have to really look at why they're not growing anymore. Maybe their drugs aren't going to be, their drug pipeline isn't great. But so that's a good reason to sell or position into some other company. Okay, let's look at Colgate. This is a dividend stock. Almost every dividend stocks are following this pattern here. Okay, CSX just dropped to here recently, today. I'm not sure why, but if this stock drops a lot, I've held this for like 15 years because I know over time that they'll improve their efficiency of their network and they have a monopoly. So I'm never going to sell this one. But right now it's pretty overpriced. You have to wait for it to go down. Let's see. Okay, so let's look at Meta Platforms. Okay, this is they basically defied gravity. They came out with a new Twitter product, and they're talking AI and a couple other initiatives. So they're a lot of traders now are starting to take 10% profits out of these stocks that ran up. Right now, the first step is to go down to this lower end of the trade, and if it goes below that, then it'll probably correct down to this level here. See, but they're overbought. You can see that they're 84, so it's not a good time to buy that. And JP Morgan is also super overbought, 894. Let's look at one more stock. I wanted to. You can see most of the drug companies have been in a downtrend, and all of a sudden they're catching a bid, and they're starting to be more in favor. CVS, this is interesting. They've been in a downtrend, and they have a single-digit EPS. Let's look at their numbers. They're any good now. Hold on. We're going to do two more. We're going to do this one and Ford just to check on these. Okay, so they have a PE ratio. Let's see what the PE ratio is for CVS. So CVS not only has the stores, they also have one of the largest health networks for insurance. The PE is 24. Okay. Let's look at the earnings. Okay. This, they're not growing at all between 23 and 24. Okay, we got 8.59 divided by 8.8. That's 3%. 8.88 divided by 9, so 10%. 9.86 divided by 1.92. 10%. So they're probably growing 10% with the PE. They're like 3 times overvalued right now, even after going down a lot. What we're going to do is we're going to go over one more stock before we're done. We're going to go over Ford. Right now, this Ford is in the trading range. They do pay a dividend. They have some bad news recently about they had to reduce the price of their Lightning trucks. So that isn't good by $10,000 because Tesla is reducing their prices, so they might have some kind of, that means their demand isn't great, and that also means that their margins aren't going to be very good. They're not making as much per vehicle. Let's look at their numbers now. We haven't looked at them for a while. Okay, PE is 19 according to their earnings. Okay, they pay a 4% dividend, first of all. Their PEG ratio is 1. 4 PE is 8. Okay, let's see if they're growing at all here. They didn't grow from last year to this year. It was basically zero growth. Let's look at, okay, we're looking at this section right here. That doesn't look good. That's basically they're just breaking even for the next 4 years. So it used to be, for us, we were looking at this, it used to be this growth, potential, but right now, the earnings estimates have been flat. Look at that, they're not even growing. And the P is 8. So I guess if you want a dividend, you get a 4% dividend, but that's all you're going to get from the company for growth. It's becoming less and less compelling, as we were thinking before. This EV could be the answer for the company to supercharge it. But right now, the demand for their EV vehicles isn't that great. They have to reduce the price, and that's going to affect. I think Tesla's reducing their price is causing them not to make money, and that's causing these earnings to be flat. That's not good. So I guess they'll pay their dividend, but they're not going to be growing. So it's becoming less and less compelling for us to look at. All right, that was a good exercise. Look at some more. This upstart company, we've been following it for a while. They basically still don't have earnings yet, but they're up on the promise of AI. And I think I've gone over my time. All right, so thank you for attending. I hope you have a good weekend, and I'll see you next time.
Thanks, Greg.